Imagine your favorite fufu joint. You can walk in anytime, buy your food, and tell everyone how good it is. Now imagine one day you show up and it's suddenly closed to the public, only making fufu for its owners and a few friends. It's still making fufu, but you can't just buy from them anymore. That's kind of what happens when a company on the stock market decides to go private. It's a huge deal, especially for us everyday investors. Welcome to the Investment Nerds, your personal guide to investing in the African stock market. 1. What does going private actually mean? When a company goes private, it means it stops having its shares traded on a public stock exchange, like the Ghana Stock Exchange. It buys back all its shares from the public and becomes owned by a small group of individuals or another company. Delisting. This is the official term for when a company removes its shares from the stock exchange. Companies that trade publicly are called publicly traded companies. When they go private, they become privately held companies. 2. Why would a company want to go private? Less stress, more control. It might sound strange for a company to leave the spotlight, but there are several good reasons. Public companies have a lot of bosses, all their shareholders. They have to report earnings every 3 months, deal with public scrutiny, and worry about their stock price daily. Going private removes this stress. Being public often means focusing on short-term results to keep investors happy. Private companies can make decisions that might not look good in the next few months, but are better for the company in the long run. No more audience. Think of it as performing on stage versus practicing in your living room. When public, everyone is watching. Private means fewer eyes and more freedom to experiment or restructure. Being a public company is expensive. There are huge legal fees, accounting costs, and regulatory filings. Going private saves money. 3. How does a company go private? Buying back shares. There are a few ways this can happen, but the main one involves buying back shares. Sometimes the current management, the bosses running the company team, decides they want to own the company themselves. They borrow money to buy out all the public shareholders. Leveraged buyout, LBO. This is very common. A private equity firm, a company that specializes in buying and improving private companies. Or another company borrows a lot of money to buy all the shares from public investors. These are like special investment groups that buy entire companies, fix them up, and then usually sell them later for a profit. 4. What happens to you, the everyday investor? Your shares get bought out. This is the most important part for us. If a company you own shares in decides to go private, you don't lose your money. The company, or whoever is buying it out, will offer to buy your shares at a specific price. This price is often higher than what the stock was trading at before the announcement to entice you to sell. You then sell your shares, get your cash, and that's it. You're no longer an owner of that company. This is not financial advice, and you should always do your own research or talk to a professional before making any investment decisions. Going private can sound scary, but it's often a planned business move where public investors get bought out. Tell me in the comments, would you be excited to sell your shares for a higher price or disappointed if a company you loved went private? Subscribe for more insights and let's get this financial wisdom.